Just waiting on more people to join. One moment. Well, good morning and welcome everyone. Tomorrow is a big milestone for the company as we hit the boards on the ASX. And I'd like to begin by thanking our new shareholders. I can see many of whom are on the call today. And to others joining us today, thank you for your interest. Honestly, we're delighted with the feedback we've got from the market. And we've also had a lot of positive press over the last few days. So it feels like the IPO's been perfectly timed. I've got a few members of the team with me here today. Anthony Bonino, our CFO, Shane Westlake, our Technical Director, and Exploration Manager, Aaron Bond. And on behalf of the team, I think fair to say, we're very excited and looking forward to getting off on the right foot in the market tomorrow. So today, just a handful of slides. I'll spend about 15 minutes talking, and then there'll be an opportunity for Q&A at the end of the presentation using the Q&A button on your screen. So if you can just type through your questions. But the purpose of today is really to talk about a few developments, very positive developments since the book build a couple of weeks ago. And I know there's a lot of interest in our Kanga 1 well, so we'll begin with that. And then I want to take a look at the recent Pavo discovery and its implications for Finder as one of the main players in that Dorado trend and the only player with 100% equity in that acreage. We'll also take a look at the oil price and some recent major macro events there. The oil price, of course, is the barometer for the sector, but for Finder, it's a key driver for the success of our strategy, as you'll see. So I'll share my screen and we'll kick off. So hopefully you can all see the presentation before you now. This old girl is the Ocean Apex. Woodside, the previous operator, has now finished with the Greater Western Flank Phase 3 project. So we're on schedule for handover of the rig as planned on 1 May. So only a few weeks away. If you turn your eye to the map here on screen, Kanga is a big structure. It's right in the heart of the northern Carnarvon Basin, which is a really oily province. You can see there near the Mutineer Exeter field, which significantly outperformed, produced around 100 million barrels. And Kanga has the potential to be a company maker for us. It's got a very good chance of success. We know this area very well. Independently assessed resource potential, the best case from ERC there, is 170 million barrels gross. And that's over 25 million barrels net to Finder. So if you think of Kanga as a Dorado-like event in the success case, Dorado, of course, has around 160 million barrels of liquids. So I say this is a company maker. The key difference for Finder is that IPO will have only around 150 million shares on issue. So significantly more share price leverage for the success here. So it really is great to have such a big catalyst so soon after listing. But keep in mind, this is just one well. I'll talk a bit later about what we're calling the perfect storm and the deals we hope to generate that will put more, and we hope many more wells like this on the agenda. So look, this is a bit of a technical slide, but the key messages are very simple. If you can see my cursor on screen, that's the Dorado field. It's a whale of a discovery. It's the biggest oil development in Australia right now. And recently, Santos announced a discovery here, Pavo, which has added 80 million barrels to that project, the tieback. So the Dorado trend is shown on the map. It runs through here, and you can see a string of prospects here. So they're the targets in our 547P block that we hold 100%. And these are big targets, each of them are around or over 100 million barrels. So this whole play has got the industry buzzing. So far, we've seen 9 out of 10 discoveries in this play have encountered hydrocarbons. So in oil and gas terms, this is the hottest property in Australia. You'll be aware that soon after the Dorado discovery, Santos acquired Quadrant in 2018 for over $2 billion. And since then, Santos and Finder have been battling it out for controlling positions in this play. And we were successful in bidding for 547P, and that was the most competitively bid block in that bid round. So this is the most active exploration area in Australia with multiple wells and thousands of square kilometres of seismic happening. And as I've said, we're the only company here with 100% equity in this play. So the 80 million barrel Pavo discovery has really ramped this play up even more. What it does is prove that the oil charge here is prolific in this play. And we found it very interesting that right off the back of the announcement of the discovery, Santos's CEO, Kevin Gallagher, announced that the break even of those Pavo barrels in a tieback is around $10 a barrel. So you can do the math, 80 million barrels with oil at $100 a barrel. If it's costing them $10 a barrel to tie it back, this project's worth billions. So this is an enormous play, and one that's evolving very successfully and bodes very well for the position we've taken here. So just looking briefly at the structures we have here, as I said, they're large, 100 million plus barrels, and similar features to Dorado. In the bottom right corner, you can see the Dorado structure. It's characterised by this shale channel incision. And similarly, this is our Fava prospect, which looks very similar on seismic, again, characterised by this incision here, and you can see the amplitudes in the reservoir sections as well. Now, the telltale sign here, Carnarvon's talked a lot about what they call fluid escape features, or FEFs. And these are features you can see on seismic. Here on the right, over Dorado, you can see this FEF shown in this image. And if we look at our Breeze prospect, which is mapped at over 200 million barrels in the P50 case, we see a similar FEF feature. Now, Adrian at Carnarvon's told us that every discovery made in this play has had these FEF features on seismic. So it's a bit of a telltale sign to de-risk these prospects pre-drill for us and also importantly for potential farming partners. Now, oil has been, as you know, on a pretty wild ride lately with Russia invading Ukraine. But I don't want you to lose sight of the long-term macro picture here. So if we look at this data from Rystad, it tells a pretty strong story. What we've seen in the industry is since oil price crashed in 2014, the industry just stopped investing in exploration and finding new barrels. They kept producing, and what we see here in the blue is the natural decline of fields in production, and the light blue is existing fields under development. Now, Rystad have a pretty aggressive forecast around energy transition, but even on their demand curves, we see daily consumption globally over 100 million barrels and growing out to the middle of the next decade. Importantly, the critical piece of this data is we see a gap emerging between demand and supply, and it's frightening. it blows out to around 60 million barrels unless the industry starts investing in exploration and finding new barrels. Look, I've also added to this curve just the impact of sanctions on Russia. So this dashed line shows where supply will come back to if you exclude Russian barrels as the third largest oil producer in the world. Now, there's a lot of volatility, and we saw when Biden recently announced the release of US strategic reserves, releasing 1 million barrels a day for 6 months, 180 million barrels total. Now, that's just a blip on the supply curve. You can see it's temporary and it's immaterial. Oil fell $7 that day. It's recovered a bit since, but you can see how these measures are nothing more than blowing against the wind. The big macro picture is alarming, but very positive if you're in the market for exploration and funds from the industry. So if we look a bit more closely at the recent history of the oil price, what this graph shows is the spike with the Ukraine invasion. But looking back over the last couple of years, oil had found a level around the mid-60s. We had the COVID outbreak. Economies were shut in, but very quickly recovered. And what we saw then through 2021 was a steady, stable growth in oil price back to around the mid-90s. And that's where we see sort of oil price bouncing back from going forward from here. So the price isn't just a function of the supply shock that Russian sanctions have caused. There's been a real shift in the level, and that's driven by in the oil price, and that's driven by, we think, long-term macro demand supply considerations. And obviously Ukraine is a humanitarian catastrophe, but what it has done is it's brought into focus oil as a national security issue. And Boris here, who's talked about, he's banged on about nothing but wind power for years, and that's been an absolute disaster for UK energy security. Now he's talking about promoting UK domestic production. So a complete reversal from him. Biden, you remember, not more than 6 months ago, he shut down, canned that Keystone pipeline after Trump had resurrected it. That would have given the US nearly 1 million barrels a day of Canadian crude, about what they released in the US strategic reserves at a time when war's on the doorstep of NATO allies in Europe. And now, of course, he's out there wanting to produce more US oil. So for the first time in a long time, it's no longer democratically unpopular to support the oil industry. And so we're hoping to see that translate to support from the government. Look, another critical factor for us is there's been a massive cash build in the sector. And I expect all of you on the call have noticed high oil prices at the Bowser. But what we're seeing is record earnings. We haven't got the benefit of earnings reports from the last quarter. So this data's from the December quarter of last year. But I've picked a couple of well-known Australian producers here to make the point. But this is also true for majors like Exxon and Chevron, who are also reporting record earnings. So Woodside's free cash flow up over 400% in 2021 from 2020, and Santos over 200%. These are happy days for the industry. But why this is so important for Finder is these are the groups that make the investment decisions to farm into our acreage and fund our wells. I should point out that coincidentally, both these groups, Woodside and Santos, are in our neighbouring blocks. They've both been counterparties to deals we've done in the past. They've been our joint venture partners. And as you will know, Santos bought Quadrant. which acquired Apache's Northwest Shelf interests, including the Dorado block, which Apache acquired from Finder. So these are groups we very much target among many others. So bringing that all together, what it means for us is what we're calling this perfect storm. We've got high oil price, the industry's cashed up. We've shown why it's vital for the industry to explore and replace reserves and find new barrels. For the first time, I think, in a very long time, we now have a social license to go and find and produce oil. And Finder's sitting here with large, high-quality positions in 2 OECD countries, very well-known, proven petroleum basins, and we're very well placed to execute our farm-out strategy. And this is a strategy we've proven successful over a long period of time. Finder's done over 25 farm-out deals, and that's a record no one else comes close to. So I think these conditions add up to a very positive environment for farm-outs and wells. And look, we all know that exploration can deliver high value. Wells and discoveries are high risk, high reward situations. But what's been unique about Finder has been our ability to create value in the earlier pre-drill stage through farm-out deals. And as I say, that's been a very successful model for us. And I would say today, we've never been as well placed in terms of our portfolio to execute these deals. It's been a long downturn for us, and we've been waiting a long time for these conditions, but we're looking to see a hard bounce. And already, I think what we're seeing is an increase in interest in farm-outs from potential farmers, farm-outs. Our UK team's been on the farm-out trail in Aberdeen recently, and the message they're receiving was loud and clear. Management teams have been told to go and find stuff to drill. So the companies in the UK have been answering Boris's call. And it feels like our entry into the UK has been perfectly timed. We're strategically positioned there in the oily part of the North Sea and the central North Sea around giant fields like Buzzard, historic fields like Bordy's Field. These are multi-billion barrel fields. And then we have Finder as a small and a new entrant picking up a large acreage position there. And I don't think, certainly I don't think that value's been recognised. I think there's been very positive feedback around the Northwest Shelf, but we also feel that we need to give due attention to our UK position. So look, that's what I wanted to go through today. Look, obviously, strap yourself in for Kanga 1. We're excited. We'll have results for that, we expect sometime in June. But also keep an eye out as we announce progress, right throughout the portfolio in the UK and the Northwest Shelf as we announce the progress on those various projects. So look, happy to turn it over to some questions. I'll just turn the screen sharing off if I can. So the first question's around 547p. When is an optimal time to do farm outs? Will you do more work prior to marketing your Dorado trend blocks or take advantage of the current industry interest in Badu? So thank you for the question. The answer is it depends. So we do look at sometimes early stage farm outs. What we have also been successful at doing is coming up with some creative solutions with seismic companies to also acquire data cheaply. And that's something that there's potential for here as well. And obviously that data adds value to any future farm out. So if someone wants to bang down the door and make us an offer that we think represents good value for shareholders, we'll certainly look at that. We are continually engaged with potential partners, but we know we're sitting on something pretty special in this trend, and we want to look to maximise the value in any deal. The prospects we have there on that trend are mapped on 3D. We would like the benefit of new data, and I think new data, again, will add value. One thing we are benefiting from here over time is, Santos and their partners are spending a lot of money de-risking that play and having more and more success. And obviously, that's adding value for us without any risk. So we're watching that story unfold. We've got the APIS well coming up now. Look, I think that's one we'll just have to see play out. The next question is talking about wells after Kanga. And look, that's something that we'll look to populate through over time as we do farm out deals. As I've said, look, our strategy rests on securing high-risk capital from the industry to fund wells. We've got a number of projects maturing into a drill-ready phase, and we'll be taking many projects to market in both Australia and the UK over the next 12 to 18 months. And as we do deals there, those deals will fund wells and give us visibility on the drilling schedule going forward. Look, if there's just last opportunities to ask any questions, otherwise we'll wrap up here. And I'd like to say thanks again for all your support. This really has been a journey for Finder, and we couldn't be happier with the feedback we're getting. There's any question. Sorry. One last question's come through. Traditionally, Finder take 10 or 15% on farm outs. Now with more funds available, what would be new farm out deal structures? Look, again, this is an interesting question. Look, every deal is different. I wouldn't say it's correct to say we take 10 or 15%. We've had much higher equity positions. What we tend to do is take 100% equity up front, typically, and then do the early stage exploration work, acquire new data potentially, and then look to trade. Obviously, we try and retain as much equity as we can. If counterparties want higher equity positions and they're prepared to give the right value for that, we'll look to modify those terms. I'd say our benchmark is around 30, 40, sometimes even 50% if we're able to achieve 2-for-1 carries, which in the past we have been in $100 oil environments. So certainly I wouldn't say 10 to 15% is a target benchmark for us. I think we're looking to do deals a bit higher. Shane, anything to add on that?
No, it is an interesting question. We've talked about it internally. Do we have more money to tip into wells? Can we be more aggressive? Can we drill more wells? And I'd say the answer is all options are on the table at this time. But we also need to realise that we've been successful with a business model of being fairly cautious with our expenditure and protecting that money going forward, and actually creating value out of our work itself. So in simple answer, we will be looking to be more aggressive, but we'll make sure we make the right decisions.
Yeah, I might just elaborate on that. I think it's been tough, but one of the good things about being a private company has forced us to be creative in deals. And that's a discipline I want to maintain. We've got a great team here that's done a lot of farm out deals and has built a very strong reputation in the industry. We've dealt with majors and large independents, and they're the groups that have the balance sheet to put serious money at risk in offshore exploration. So I think this is an important question. I think it's important for us to maintain that discipline we've developed. So we need a good reason to depart from that discipline and that strategy that's worked for us in the past. So I think that's the mindset here. But as I've said, every deal is different, and we look at every deal on its merits, and we structure every deal accordingly. So thanks everyone. Great turnout for this webinar, and look forward to continuing the dialogue with you in the future. Thank you.
Thanks everyone.
Thanks everyone.